Now, staying on the subject of M&A, twice a year, EY does a survey of CEO appetite for mergers and acquisitions. And today's the day for the latest version. Welcome now Bill Casey. He's EY America's Vice Chair of Transaction Advisory Services. He's also the co-author of the new book, The Stress Test Every Business Needs. So welcome. Good to have you here.
Thank you, David.
We're going to put up now the basic takeaway I took away, at least, from your report. And as you surveyed people, you had more than half, 51% of the business executives said in the next 12 months they intend to do something in the merger and acquisition area. 54% expect a bigger deal pipeline coming to the pipe. At the same time, 92% said as they look at their portfolio, they're interested in divesting something. So this is not just acquisitions, it's also sales.
Right. There's obviously two sides of a coin, but there's a lot of optimism out there. There's optimism not only in the deal market, but there's optimism in the economy. And one of the drivers of the deal market is the focus on divestitures. And so, we've seen this trend for quite some time. Initially, it was driven by the activists, but now companies have institutionalized their portfolio review and are shedding off the non-core assets or the underperforming segments of their business.
Another point that we covered there briefly was a large number think that there's a lot of dry powder out there from private equity. Is that driving up valuations as a practical matter? Could that deter some M&A?
Yeah, no question about it. I would say, for years, we saw a buildup of the war chest that private equity has had. And private equity got back into the market with a vengeance probably about a year, 2 years ago. And there's been a big uptick in the amount of private equity deals. And we're seeing a lot of our corporate and strategic buyers are now competing heavily with private equity. And more than 50% of them see private equity as their main competitor on doing strategic deals.
As we look forward to bank earnings season, which starts this coming Friday, one of the things that Bloomberg is writing about is what is the M&A business, the investment banking business going to look like? We'll put up a bar chart, actually, that indicates in the third quarter, they actually completed M&A rather than announced, actually has come down some. Is there something underlying that, or is that just a matter of timing?
I think it's a matter of timing. I think if we look at, you heard from our survey that most of the respondents are going to see an uptick in their M&A pipeline. We're talking about announced deals here, but there's lots of deals that are going on right now as we speak. So there's some cyclicality to it. And I would say with the overall deal market itself, I think there is going to be some adjustments in the valuation with respect to those companies that tend to be more cyclic.
So is it a buyer's or seller's market right now?
Well, clearly it's sellers. And I think sellers have gotten very sophisticated in terms of the number of participants in deals. So there's a big uptick in deal activity because there's a lot more buyers. Private equity has moved in. Large family funds have moved in, sovereign wealth funds. So sellers have gotten quite sophisticated in terms of the number of potential buyers that are looking at deals, which is obviously pushing the asset valuations up.
Do they have a different set of individuals they can go to and talk about it? In that CFIUS is going to say, no way, no how, China. We're not going to have any sort of a cross-border M&A. We heard earlier that some of those transactions like Rockwell are going to be in doubt. What do you hear on that? Yeah,
I would say, look, first of all, there's really nothing, I would say, particularly new about CFIUS. There's obviously been a new law enacted, so we do expect an uptick in the number of deals to be looking at CFIUS. But the U.S. isn't alone in this. Other countries are looking at this, as well. Germany is relatively active in this. So, new regulations, law changes are always going to be detrimental to the M&A market, but we still expect to see a fair amount of activity.
Well, even before the statute was changed, this administration was enforcing it much more often than any administration had in the past. There were more challenges. So, as a practical matter, does that mean even if the level of M&A remains the same, does it become more domestic? Is it more internal as opposed to cross-border?
Yeah, I would say I'll say two things. One is clearly in the U.S. The corporate buyers are very focused on the Americas. So in terms of looking offshore, we're seeing that most of, when we talk to U.S.-based buyers, they're looking first at Canada, then they're looking at Latin America. And I would say as it relates to CFIUS, they'll likely have the two sectors that'll be impacted by it are primarily the hardware companies and certain software companies.
What about inbound overall, not just in China? Do you see a trend inbound M&A? Is there a reduction?
No, I would say the U.S. continues to be the #1 target around the globe in terms of inbound investments.
Bill, how do you feel like M&A will be financed?
Well, the credit markets this is a great time for M&A. Look, we have...
Even though we've seen the rise in yields, I understand that the high yield investment grade market hasn't seen an effect. Just look at Comcast bond offering last week. But going forward, do you feel like it'll continue like that?
I would say, right now the credit markets are very favorable. With respect to that, there is some anticipation that if there is a change in the credit markets, perhaps now is the time to get in and lock in more favorable rates. So there's likely to be, some impact going forward if there is going to be a change in rate.
What we also learned last week was just how tight the labor market is in the U.S. How much of M&A in the U.S. do you feel like is because of labor, because you need to buy the talent because you can't get them any other way, versus a different reason? Yeah,
no question about it. One of the ways to save a problem of attracting employees is doing deals. And I'd say more specifically, there's a real shortage of folks at the higher end, particularly in an economy where innovation is key. So the ability to use M&A as a way to solve a problem around retention and attracting talent is key.
Finally, we've gotten through this whole discussion without talking about tax cuts or repatriation. Has that affected M&A for U.S. companies?
I would say from a repatriation, cash was never the problem in the first place. So cash and credit was pretty available. So with respect to repatriation, certainly I wouldn't say was a trigger in terms of an uptick. But as it relates to tax cuts, clearly there has been a benefit of just having more capital in the system to redeploy.
All right, Bill Casey, great to catch up with you, joining us from EY.